Welcome back to our panel of experts who are discussing the second quarter GDP numbers, which have disappointed. The expectation was that it would come in at 7.4%. It's come in at 7.1%. Speaking to us are Dr. Sudipto Mundal, Dr. Pranab Sen, Dr. Soumyakanti Ghosh and Dr. Ashima Goyal. Okay, I think the Bengalis are overrepresented here, as always, in a panel of economists. Well, let me come back to the numbers that I wanted to discuss with Soumya. Soumya, you said services, you wanted to add a bit more. There've clearly been a disappointment with trade, hotels and transport, like we were discussing with Sen, coming in at 6.8, and finance doing even worse at 6.3, considering that the NBFC and the debt market problems were fully felt only in October. Will we do worse in the third quarter on these fronts?
Yes, exactly, Latha. And before that, I just want to quickly add one point. I was actually looking into the data of the deflators of agricultural sector from FY06 onwards as per the new back series which was released yesterday. I think one of the possible reasons why the GDP had grown at in excess of 8% in those years was as the nominal GVA agricultural deflator has grown in excess of 10% in all those years. So I think rural demand was one of the factors which has pulled up demand, which is sadly absent as of now. Now coming to your the service data, I think you are correct. I think most of the problems have started in October. It has continued in November, possibly subsiding, and maybe towards the end of November the oil prices decline could give a boost to the consumption. But my fear and sense is that if I look into those two subsegments, the trade subsegment and the finance subsegment, if I take a trend growth of their data for the last couple of quarters, I can see that that growth is stuck at 6 to 6.5%. Until and unless it breaks out of that bucket of 6 to 6.5%, I think it will be very difficult for the service sector to grow at more than trend, and that will work as a constraining factor on the overall GVA numbers. And the second thing which I wanted to mention over here is regarding the consumption factor. I think consumption PFC has decelerated to 7% in this quarter, and this is some sort also has been declining now after increasing, now has declined again for the from last time. And if it continues to decline, I think that will have some sort of an impact on the investment, which is at a nascent stage. So overall, the third quarter and the fourth quarter outlook doesn't look too rosy at the moment.
Okay, well, that's not looking too good. Actually, Dr. Mundal, before I come to the monetary policy arguments that Ashima Goyal was making, speaking about the space for rate cuts and monetary stimulus, let me just discuss the fiscal numbers that came in a little while ago. The fiscal deficit for October is double what it was in the year ago. It's 54,000 crores compared to 26,000 crores. And likewise, the revenue deficit is again double, about 41,000 crores compared to 21,000 crores. The April-October fiscal deficit is already standing at 6.5 lakh crore, overshooting the full year numbers. Of course, expenditure comes earlier and tax revenues catch up, but the tax revenues are looking pretty bad. April-October tax mop-up at 10.3 lakh crore is only about 5% more than what it was a year ago. So, you know, there isn't so much of fiscal space. What do you think the government will do or can do? Will it throw fiscal discipline to the winds?
Yeah, no, I think you've actually given a very good analysis of the outlook on the fiscal front. There is really very little elbow room, you know, in terms of, because we already used up a lot of the deficit that was budgeted for. And I don't see, you know, strong performance in terms of recovery of surpluses from public enterprises and so on. The dialogue is, of course, going on with the RBI on how much the government will get out of that surplus. So I don't want to go into that at this stage. But yes, I think the fiscal situation remains quite tight. And, you know, there are a lot of headwinds out there. Of course, the oil price decline has been a big help. But there are many other problems, especially with the trade war between the US and China, and so on. So we need to be careful, and though there are obvious pressures because of election coming around the corner, I hope the government will maintain fiscal discipline. So it's quite risky at present.
Yes, it would be. But actually, but let me take Ashima Goel's point to Dr. Sen. There's no denying that real interest rates are high, especially if we extrapolate the inflation at current levels. And the Reserve Bank has only recently moved in to a calibrated tightening stance. Do you think they should quickly reverse, even if it means loss of face? Or do you think that by their very nature they will have to wait? Because who knows, if oil prices can be at $86 during the October policy and move to $56 by the December policy, it might well move towards $80 by the February policy. So how much should the Reserve Bank take liberties? Can it change stance? What can it do at all? Dr. Sen.
So let's be very clear about one thing. Again, we're talking about headline inflation. But the fact is core inflation continues to go up. The whole headline inflation drop has been driven by agricultural prices. Now, what we do know, that the interest rate policy has virtually no effect on agricultural prices. We found this out to our cost when we were running double-digit agri-inflation earlier, and the RBI had gone in for serious tightening. It's completely symmetric. If it doesn't work when inflation is high, it's not going to work when inflation is too low. So, but the fact of the matter is that your core inflation, which is sensitive to interest rates, is continuing to go up. So you've got a conundrum.
You have, yes.
Yeah.
You do have a conundrum. The MPC will perhaps debate that. Ashima Goel, I have another conundrum to what you are suggesting. Yes, it does look, when you look at the real interest rates, that there is gap, and maybe it would not be fair for the MPC, which has been given a headline target to look at core inflation and take its policies decisions all the time. But Ashima Goel, the banking sector is a bombed out sector. The bankers are a bombed out lot after what they have been put through, both by the CBI and in terms of CEOs being packed off. Recently, the RBI allowed NBFCs to securitize more easily. But the bankers we spoke to said, no, we are not going to be party to a securitization of loans which they have had in their books for just 6 months. Who knows how it will behave? We are only going to buy loans that have at least 1 year more and have shown performance. So the bankers are not going to take risk no matter what you do to the interest rates. Really, is there a fiscal or a monetary chance to improve the economy?
Well, I think liquidity is an issue. It has been much tighter than neutral when they're committed to a neutral stance on liquidity. And maybe now as inflows revive, they can act faster on that. They will be buying dollars as well as doing OMOs, which should improve, which should help the financial sector. And for banks also, I think the NBFC problems are actually an opportunity because liquidity is going to go through banks. They assess commercial risk, and there's an opportunity to improve their interest earnings. And in a way, this points to a more sort of robust financial sector in some sense. So I think there are opportunities there. Interest rate, I think durable consumption
can be effective, you think?
Yeah, and investment is sensitive to that. So there is space there. There is opportunity for some stimulus, and they should. I think one reason is a puzzle to me why liquidity was kept so tight, and it might have been to defend the rupee. Need to. So now that the rupee has recovered to 69, they need to really accumulate reserves again rather than let it strengthen more.
Yes.
And so that pressure will go. Perhaps they'll act faster on the liquidity front, which will be a positive for...
well, they have been announcing 40,000 crores of open market purchases every year, every month, October, November, and now December as well, even before the month started. And some of the things have come suddenly on them. Credit leakage in the weeks before October. I don't think anyone penciled in 50,000 crores every week. As well, the sudden attack on the foreign exchange and the draining of dollars. Too many things.
I wanted to make one more point.
Yes, sure, please. please.
About that oil could climb again to 85. I think the key issue was this November, the Iran sanctions. And once that is through, there are many long-term factors pointing towards softening.
Yes.
So I think we can relax a little bit on
Sure.
front.
On the inflation front. Yeah, we will have to see whether, how that instrument is used. But Dr. Mundal, what would your best guess be on the second half? After all, investment has picked up. It's 12.5%. And we have advantages like, low crude, which is usually which is a stimulant, at least to the corporate sector, to the non-agricultural sector. Do you think we can see some positive points over here? Or do we have to reconcile to a less than 7% growth for the full year?
I would still sort of, lay my bets on just about making it 7%. But I can see that because of some of the risks that we have been discussing, it could slip below. So, we're on the borderline. If 7% is something important to achieve. But I should mention, apropos some of the earlier discussions, actually 7% growth rate is really very high.
Yes. Okay.
By, global standards.
Oh, yes, even by our own standards, considering that the back data has been revised lower and what we thought were 8 and 9% years, actually we now know is the average is only 6.7. Looks like our potential growth is sub 7 and we assumed it otherwise. Soumya, very quick thoughts on your full year estimate. What may it be, you think?
I think last year we expanded at 6.7%, the year before that at 7.1%. So I think that this year if we grow at maybe a sub 7% or maybe higher than 6.7%, it will be good. It will be good for us. But 7% as of now looks a tad difficult to attain this fiscal.
Okay, Dr. Sen, just a monosyllabic answer, sir. What's your best guess for the future?
I tend to agree with them, but with one upside, which is that historically the quarter before election has seen a huge surge in consumption expenditure because all the political parties empty out their coffers.
Okay.
And get down to it. I'm hoping that's going to happen. Okay. So I have equally bad vibes about Q3.
Okay.
But Q4 I'm a little bit more bullish on.
Okay. Generally, the team here believes that with difficulty we will reach 7, but going beyond that looks very tough. Thank you very much for joining me on this special discussion of the Q2 GDP numbers.